Ladies and gentlemen, welcome to the Motivate Property Podcast. It is Thursday, the 27th of November, 2025. I hope everyone out there is having a fantastic week. So guys, this week we are talking about negative gearing, right? This topic is very much, let's just say it's a hot topic, and it's continuously a hot topic over time, right? Because there is a fair bit of misinformation when it comes to what negative gearing is, how it works, the benefits, and really, I guess, kind of the pros and cons. So today we're doing a deep dive into negative gearing, right? And really kind of discussing really what this means and kind of going through a bunch of questions that we've been receiving from our clients and listeners of this show. So without further ado, I'm going to get stuck into today. Now, firstly, I think it's really important to understand gearing when it comes to property investment, right? Now, really fundamentally, when it comes to gearing, what we're talking about is the operating day-to-day costs of owning an investment property. That's really what gearing is, right? I'm going to sort of explain this in just a sec. Now, before I do, I think it's really important to understand the mechanics of property, right? And really kind of going through fundamentally, what is the benefit of buying an investment property? What are the metrics that we want to physically receive from that property? Because this really starts to make sense when it comes to gearing, right? So firstly, in Australia, for those who've been listening to this show for quite some time, and anyone who's our client would sort of understand how confident we are in the Australian property market. In fact, I think that the Australian property market in terms of wealth generation is by far one of the best places to put your money basically worldwide, right? And that has to do with the fact that we don't have enough houses, we can't build enough houses, our population grows way faster than what we can actually construct. That supply and demand balance is the main reason why over the last 100 years, we've continued to double pretty much every 10 to 15 years in value. Now, what I'm speaking to right now is capital growth, right? So when it comes to Australian property, there are fundamentally three benefits that you get. The first benefit is the capital growth. It's buying the house today for $700,000 and it's worth $1.4 million in roughly 10 to 15 years time. That's the number one main benefit you get from investment property. In fact, that is the main reason why you invest in property, right? So as an example, I know most people who are listening to this may know of a relative or a great uncle or grandparent or whatever the case is that bought a house in Perth back in the day for 10 grand, right? And that house today is worth $1 million. Imagine having a time machine going back to 1960. We could buy the house for 8 grand, and instead of buying one house, you bought 50 of them. All right. Now, yes, everything's relative. Your income would have been nothing back then, but the fact of the matter is, you would have bought a bunch of houses back then for $8,000, 10 grand. Today they're worth $1 million. You are worth millions and millions and millions of dollars. That fundamentally is the main power of property investment. It's all about capital growth. The second benefit when it comes to property is cash flow. Now, the cash flow that you receive in rental income works against the mortgage and all the costs of owning that property. That's gearing. Right, so I'm really going to do a fairly big deep dive into gearing in just a second. But what happens over time is as the mortgage comes down, as the rent starts to grow, it becomes more and more positively geared over time until you've paid the mortgage off, or the tenants have paid the mortgage off, and then you're essentially receiving the full rental income week to week, minus all your your holding costs and expenses like council rates, water rates, insurance, and maintenance. But the point is that you get to a point in 30 years time, you got no mortgage on that house, and if you're making $800 a week, you're practically getting that week to week less those costs, right? So that's what we're talking about when it comes to gearing or cash flow from property. The third benefit comes to tax, right? Now in Australia, we are an absolute tax haven when it comes to property investment. In fact, once again, just like the capital growth is super, super strong in Australia because of our supply and demand, because the Australian government knows that we need more houses, the tax system is incentivizing property investment in a way that you can essentially claim your full cost base of the property, depreciation. You can also claim the losses that you're making on that property against your personal taxable income to offset the cost of owning the property, all right? So in other words, Australia is one of the only places in the world that treats property investment like a business.
If you're overwhelmed by property investing, you're not alone. Most people waste months researching the wrong suburbs, stressing over inspections, and second-guessing every decision. Motivate Property cuts through all of that. We analyse the data, shortlist the strongest opportunities, inspect on your behalf, and negotiate so you don't overpay. The result is simple: a property that actually performs and moves you closer to financial freedom. Learn more at motivateproperty.com.au.
You got your income, you got your expenses, you get to claim depreciation, so the fact that the house is getting older, and you get taxed back accordingly when it comes to working out those three figures. Now, the fact that we get to claim depreciation, we get to claim so much back in tax against our income helps offset our income. And it essentially allows that, and really what it means fundamentally is property investment in Australia is actually very tax positive because of the way that we can work it against our income. So like I said, guys, there are three components to property investment. There's the capital growth, the number one most important thing. That's what's making you wealthy. Secondly, we've got the cash flow, otherwise known as the gearing. The gearing is the week-to-week holding cost or holding income you get for holding onto that property long term. The third is the tax benefits. All right, but what I'm going to do a deep dive in today is the gearing, which is point number 2. Now, secondly, just as a little disclaimer here, one of the things that I hear often from people is that they're basically buying a property with the intention to positively gear it or with the intention of negatively gearing it. I just want to say, if that's you, or if you hear someone saying, I'm buying this property and I'm going to negative gear it intentionally, I would be questioning whether that's a good move or not, right? And really what I'm trying to say here, without, I guess, sort of offending anybody, gearing is not a strategy. Gearing is an outcome of your strategy. So what I'm essentially saying, you don't buy a property to positively or negatively gear it. Bad idea, bad move, very naive. Positive or negative gearing is the outcome of the strategy. It's not the intention. It's the outcome. It's the output. Right? Now, really what I mean when I say that, and I'm going to get into some numbers in just a second to kind of really show you guys the mechanics of this. But fundamentally, if you buy an investment property tomorrow, and let's just say, for example, that investment property is the median price in Perth, it's around $800,000. So you borrow $800,000 to go and buy it. If you're getting $800 a week in rental income, right, that property is what you would call negatively geared. Now, the reason why it's negatively geared, and I'll bring up some figures here. All right, so if we look at an $800,000 property and we've got an $800,000 debt, getting $800 a week in rent, right, with a 6% interest rate, and that's also paying for the council rates, the water rates, the insurance, the maintenance, and the property management. Assuming that you're in a tax rate of 37%, getting your full depreciation, that house would be negatively geared by about 30 grand a year. So you would be essentially losing negative cash flow of around $30,000 a year before you start claiming tax against it. Right? Now, what that essentially looks like, $800,000 debt, 6% interest rate over a 30-year period, that's just over $57,500 per year in interest, principal and interest repayments. Then we've got the council rates at $2,500, the water rates at $1,500, the insurance is around $2,000 a year. That's your building and landlord. Then you got about $1,000 a year in maintenance. So that's $64,500 a year in expenses. Right? So for you to just purely own an $800,000 property today with 6% interest rates and just hold on to it empty, it's going to cost you $64,500 a year. But you're not going to do that because you're a smart investor. All right. Now, a smart investor would put a tenant in the house. Tom, the tenant, moves in and he's going to pay $800 a week. Why? Because that's the going rate in your area. All right. Now, that gets us a weekly rental income or an annual rental income at 48 weeks of the year, because we also build in a 4-week vacancy with all of our figures. That means you're going to get $38,400 per year in rental income. Now, once we take away management fees, it means you're getting around that kind of 34 grand a year in income. So the house is negative 64,000. You're getting positive 34,000 in income, which means this house is actually costing negative $30,000. This is a negatively geared property. All right. Now, this is where it gets good for tax. So once we start claiming depreciation, we remove the principal out of the equation because we can't claim the principal part of your repayment against your tax. That's going to give you around a $30,000 tax deduction. So if your income is, let's just say your income's $150, right? You're claiming $30,000 as a tax deduction. It means you're only paying tax on $120 now. You're not paying tax on $150 because this property is soaking up $30,000 worth of tax deductions on your income. So you're only paying tax on $120 moving forward. That means at your tax rate, you're going to get about 11 grand back in tax physically in cash, which means the house ends up costing you 20 grand for the year. But remember, out of that 20 grand for the year, $9,500 as principal. That money is your money because that's your debt level coming down and building equity, which we're going to reuse and repurpose to buy more houses, more properties, more shares in the future, and we're going to keep reinvesting that. All right? So fundamentally, what it means is once we start claiming taxes, the house has gone from costing $30,000 a year to now only $9,600. So you've practically just wiped off around, $11,000 in tax, plus obviously removing the principal. You've just wiped off practically about $20,000 off your expense base. So that is the power of tax and tax deductions when it comes to property investment. All right. But like I said, guys, what we're talking about today is gearing. Now, like I said, the gearing of this particular example is an outcome of the purchase. Now, if someone says to you, hey, look, I'm buying this house and I'm doing it to positively gear it or to negatively gear it, it kind of tells me they don't really know what they're doing or talking about, because that's an outcome of a strategy. It is not a strategy, right? And I want to make this as clear as I possibly can. Positively gearing or negatively gearing is not a strategy. It's an outcome of the strategy. Now, the question then begs, well, Corey, hang on a second. If positive gearing or negative gearing isn't a strategy, well, why can't we just get houses that are just positively geared? Like, wouldn't that just be better? Sure. In a perfect world, yeah, fantastic. But that's just not how the world works, right? And I want to kind of break this down, right? So just so you guys can really understand this. So firstly, most people, when it comes to buying an investment property, they're using equity, right? Now, the reason why they're using equity is because they didn't buy an investment property first. Most people, what they go and do is they buy a home first. Now, when you buy a home, you're obviously going and buying and purchasing a property, you're going to the bank and getting a mortgage, and obviously over time you're building equity because you're driving that debt down, and obviously the house is growing in value, your home's growing in value. Now, the difference between the value and the debt is your equity. Now, once you get to that point where you've got your home, it's nice and safe, you love living there, it's all fantastic, and then over 2, 3, 4, 5 years' time, the house is growing and the debt's coming down, you're now probably sitting on 100 to 200 grand worth of equity. So for the most part, like the average person who's investing, what they're essentially doing is they're borrowing equity from their home. They're using that equity as a deposit and costs for an investment property, which means they're borrowing 100% of the value. Because if you're going to go and buy an investment property for $800,000 over here, but you're borrowing the deposit and you're borrowing the remaining mortgage with a different bank, you're borrowing 100% of the value, right? So that's why when I'm working on this calculation, you're buying an $800,000 house, but you're also borrowing $800,000 in order to purchase it. Now, the point is, if you're going to go to the bank and borrow 100% of the value, that's going to be negatively geared all day long. Like, there is not a single property in the country, unless you're taking an extraordinarily high risk, there is not a property in the country that you can go and borrow at 100% loan to value ratio, and that's going to be positively cash flow before tax. It's just not. Now, there are ways of doing that, right? And when I say risk, I'm talking about buying in mining towns where you're buying a house for, let's say you go to Karratha, right? You buy a house for $400,000. It's paying you $900 a week in rental income. Sure, that's positively geared. But for those who've invested in those areas or know the Karratha or mining town markets, they boom really hard, they crash really hard. And there's many people who go bankrupt in investing in those sort of places. So unless you've got the appetite and risk to go into mining towns, I'd say it's probably a bad move. Now, one of the ways that we help our clients, invest in positively cash flow properties is by doing multi or co-living properties. So a multiple occupant or a co-living property is when you've got a house that's built to purpose. So it's built as a 3-bedroom, 3-bathroom or a 4-bedroom, 4-bathroom. Every room has an ensuite, and you're renting out room by room, whether it's to students or nurses near a hospital. It's built for that particular demographic, right? So like share houses. Share houses are a lot more positively cash flow, but there's more risk. There's more volatility. There's more wear and tear. There's more in and out and tenant variability. There's obviously other costs and other risks you're going to have to factor into your strategy if you are going to start taking those sort of risks. We generally recommend clients start buying those kind of houses roughly 3 to 5 properties in, right? So they get a bit of a nice safe buy and hold foundation first, and then we can start taking those bigger risks. But the point is, if you're going to go to the bank and you're going to go borrow 100% of the value, like, guys, it's negatively geared. Like, there is nothing that you can say or do that's going to make that thing positive. It's just not reality, right? So that's the first thing that I want to say. Now, secondly, the gearing itself, for the most part, is actually outside of your control. Now, the reason why I say that, let's think about tax. Not tax, sorry. Let's think about interest rates, right? So today, interest rates are at 6%. And just to be clear, I'm using the exact same numbers that I was using before, right? So $800,000 value, $800,000 debt, $800 a week in rent. Now, if I put those numbers in, but instead of using a 6% interest rate, I use a 4% interest rate, that means that the house is only negatively geared by $18,000 a year. So it went from negative 30 at 6%, now it's only negative 18 before tax. So it's still negatively geared. But because we're claiming a big chunk of depreciation and we're claiming the tax deduction, that property, interest only, is actually positive by $475 per year or $9 a week. So that's an example now of a negatively cash flow property that is giving you healthy tax deductions. And once you receive those tax deductions, it's actually now a positively geared property. All right. In other words, you're getting kind of the best of both worlds, right? Now, like I said, all I've changed in that one thing is the interest rate. Now, once again, if I bring the interest rates down further from, say, 4% down to 3%, like it was during COVID, that's now positively cash flow by over $100 a week. All right. That's $5,515 per year. And again, before tax, that's now negative 13 grand, not negative 18 or negative 30, negative 13. So as you can see, the interest rates itself also swings a lot of the pendulum when it comes to positive or negative gearing. And as you've probably listened to in this show for a couple of years now, you have no control over interest rates. Your portfolio has no control over interest rates. If you're buying a property to negatively gear it or positively gear it, and then the interest rates change, and then your entire strategy out the window, you're kind of paddling up the metaphorical shit creek, right? So in other words, and just to kind of reiterate my point, positive gearing or negative gearing is not a strategy. It's an outcome of your strategy. Interest rates, if you're buying properties just to positively gear them and interest rates go up, they're all negative now. So what are you going to do? Well, you're just going to go sell your entire portfolio because then it's not positively cash flow? Kind of crazy, right? But again, this is just to dispel the misinformation that positive or negative gearing is some kind of strategy. It's not. It's an outcome. Now, let's say you say to me, hey, Corey, it's all well and good, but I've got lots and lots of cash here. I've got lots of money to invest. I want to buy one property, and I want that one property to be positively cash flow without taking extraordinary risk. What would you do? So here are some numbers. Let's just say, for example, you want to go buy a house worth $800,000. So that's the average property in Perth today. Now, let's say you've got $800 a week in rental income, so the same figures as before. That mortgage is not going to work there, so let's try $375. Perfect. So that's worked. So here are the numbers.
Whether you're buying your first home or third or fourth investment property, Motivate Finance Team has you covered, finding the best lender to fit your needs. And here's the truth. If you haven't reviewed your lending in the last 12 months, you're probably overpaying. Banks reward new customers, not loyal ones. We review your structure, compare lenders, and build a finance strategy that actually supports your long-term goals. Whether you're refinancing, upgrading, or building your portfolio, your lending setup matters more than you think. Visit motivateproperty.com.au/finance to get started.
Let's say you want to go to the bank, purchase a property. The median property in Perth is around $800,000 today, and you want that property to be positively cash flow. In order to do so, you would need to have a cash deposit. So in other words, you can't borrow the deposit from your equity. You have to physically find cash to go and do this. In other words, the overall debt against the property is a lot less because you're using cash as the deposit. The mortgage would need to be $375,000. So you're buying an $800,000 property, and the debt afterwards, after the purchase costs, needs to be $375,000. Now I'll show you the numbers. A $375,000 mortgage at 6% interest rates, 30-year mortgage, your repayment's $27,000 for the year, 27. Then we add the council rates, the water rates, the insurance, the maintenance. That's $33,000 in expenses, $33,900. If we get $800 a week in rent minus the 4 weeks of shading and then property management fees, that means that you're actually getting 34 grand in. So 33,900 out, 34,100 in. It means you're positively geared by $196 per year. Per year. So let's just get this straight. In order for you to buy a positively geared property, now when I say positively geared, I'm talking less than $200 a year. So that's not actually going to be replacing your income in any way, shape, or form. In fact, if you're going to go invest to have a positively geared property and have that property make you $200 per year, it's kind of insane, right? It's kind of like, I guess my question is, what the hell's the point of even doing that, right? But here is the problem. You have to put down in cash $425,000 plus costs. So you're probably looking at another 20 grand worth of costs there. So the reality is you physically need almost $450,000 in cash to buy one home, for that one home to be positively geared by $200 a year. Now, for those who have been our clients or somewhat paying attention to this show for the last couple of years, you would know what I would do. If I had $450,000 cash, I'd be buying 4 houses with 4 $100,000 deposits with a $50,000 buffer designed to run the portfolio for me. That $50,000 left over is going to be sitting in an offset account designed to absorb the negative cash flow on that 4 property portfolio. That's what I'd be doing. Why? It allows me to use the least amount of my money to purchase the largest asset base that I could go and purchase. Right? So again, just for ease of numbers here, right? If I had $400,000, that's 4 $80,000 10% deposits on 4 $800,000 properties. 800,000 times that by 4 properties. So that $450K has allowed me to purchase a $3.2 million property portfolio. If that portfolio only grows at a 5% growth rate per year, that means my portfolio now is making me $160,000 per year in growth every year that goes on. That $50K left over, that's designed to run the cash flow. That's designed to absorb the negative cash flow year on year. Now, if I've got 4 investment properties that are being absorbed negatively cash flow with a $50,000 buffer, it's probably going to take a good sort of 4 or 5 years for that buffer to go down to zero. And in that 4 or 5 years, I've made over $640,000 in growth, which I can pull out and top the buffer back up. So I'm now using my own equity as the funding to fund the negative cash flow. Like, that's what I would do personally. The idea that one person would go and use $450,000 of cash to buy one house just so they can positively gear it, that makes them $200 per year, is so insane that I don't have the words. Right? It's moronic. Like, no one in their right mind would actually do that. No serious investor would actually do that. But just notice how that's the narrative that's out there. Like, notice that that's really what most people are trying to do fundamentally. They can't because they don't have 450 grand laying around in their bank account. And then they think that property investment doesn't work because the properties cost them something. Guys, it's insane. Not how it works. All right? Now, when it comes to, I guess, really positively gearing a property, right? There are 3 ways to positively cash flow a property. All right. And these 3 ways are the 3 things that I tell my clients. Like I said, number 1, if you want a positively geared property from day 1, you have to put down a huge deposit in cash. Can't be equity, has to be in cash. But if you're a savvy, smart investor, you know what you're using for your cash. You're buying as many houses as you can. And then you put tenants in those houses, the tenants pay them off for you, you reinvest the equity into other forms of asset classes, particularly cash flow heavy assets in the future. That's really what you would end up doing if you want to get the best bang for your buck. The second way of getting a positively cash flow property is to buy in a high-risk area or buy a high-risk property. So like I said, areas could be like mining towns, like places where you could buy a really cheap house that gets a lot of really high rent, but you've got to consider the only reason why people are selling those types of properties is because of risk. They got to get their money out of those markets because the markets crash too hard. Particularly when you've got certain areas or towns that are heavily reliant on 1 or 2 different employment sectors. So again, mining towns are a great example of this. Defense-heavy towns are a great example of this. When there's one or two different sectors that dominate the employment market, again, huge amount of risk in those areas, because again, if they turn around tomorrow and say, hey, look, we need to wind down this mine site, that town, the real estate in that town's practically worthless the following day. Good luck trying to sell when everyone else is trying to sell, these kind of properties. Not going to work. So like I said, high risk areas or high risk properties. So like a dual occupancy, a multiple occupancy, a co-living property, these are all examples of high risk properties. We can do them. We do them for clients. Would we recommend that being the first property for you to go and do if you're a conservative investor? Absolutely not. All right. That's probably what we would recommend more aggressive investors, or guys who've got, some properties under their belt first, right? The third way of getting a positively cash flow property is to wait. Every property will become positive cash flow at some point. Every property. All right. Let me give you some examples. So one of the things that I've built here is a 10-year calc. All right. So it's a 10-year comparison calc. What this is essentially showing is the holding cost of a 10-year period, assuming you've owned a property today and you want to hold on to it for the next 10 years, what the numbers are going to look like if we do some projections in 10 years' time. Now, what I've got here in my example that I've given my team is a $750,000 purchase price. So $750,000 is what you're buying. In this example, you've got a mortgage of $600,000. So this is assuming this person's brought in $150K as a deposit plus costs. All right. Now, 6.5% interest rates, 30-year tax bracket. 30% tax bracket. That means that the house is costing, after your taxes, after your negative cash flow and your tax back, it's costing $7,800 for the year, or $151 for the week.
If your investment property is being managed, but you're still dealing with stress, vacancies, or tenants who don't respect the home, you don't have a property manager. You have a problem. Motivate Realty runs property management the way it should be done. Clear communication, strict tenant screening, proactive maintenance, and complete transparency so your property stays protected and your rental income stays consistent. If you want a property manager who actually treats your investment like a business, visit motivateproperty.com.au/realty.
Now, what I'm doing, I'm increasing the value by 5% year on year for a 10-year period. So year one, after year one, it's worth $787,000. By the end of year 10, it's worth $1.2 million. So it's grown fairly well over a 10-year period. I'm also reducing the loan amount by the nominal principal repayment. So the principal each year gets reduced off the loan, and then the following year it vice versa, and it kind of cascades down as like a reverse exponential graph, right? But basically that shows that after year 10, the mortgage has gone from $600K to now $511,000. I'm increasing the rental income by 5% a year, right? So again, the rental growth rate is 5%. That's the average. So again, $700 per week, year one, year two, it's $735, $771. By the time we get to year 10, it's $1,140 per year. Per week in rental income. And then finally, I'm reducing the depreciation shading by 2%, all right? Because obviously depreciation is also going to be coming down over time. Now, what this is showing, year one, it's negative 151. Year two, it's negative 126. Year three, it's negative 100, right? So even just by the end of year two, so the end of the third year of owning it, basically, all right? You've already shaved off practically a third of the negative cash flow. Goes negative 72, year three, year four, year five, and it's at the point of year six. It goes from in year five, negative $12 a week to now positive $20 per week. So pretty much in year six is when the growth of the property occurs, the growth of the rent occurs, and the negative repayment in your mortgage. So the fact that the mortgage has been coming down, the property has now tipped from negative cash flow or negative gearing to now positive gearing. So what that essentially means is the house has now gone from costing you money each week to now putting money in your back pocket. Now, granted, it's only $20 a week. So that $20 a week will probably get you half a Happy Meal, at this point. But the point is, it's now in the green. It now gives you more capacity week to week in cash flow to now expand your portfolio and start buying more properties. All right? After year 10, It's now positive cash flow by almost $9,000 a year or $171 a week. So all I'm really trying to say here is point three, or way number three of getting a positive cash flow property is just waiting. Every property will turn positive. Remember, guys, a property is always the most expensive when you first buy it because you're the highest mortgage, you're getting the least amount of rent. Over time, as the values and the rents rise and the debt comes down, it's the gap that's making you wealthy. But the gap goes from negative to positive, generally speaking, in roughly that kind of 5 to 7 year mark. So between year 5 to 7 owning, that property really should become positive cash flow, just with those metrics. Now, obviously, this doesn't take into consideration interest rates, and if interest rates rise or fall, that obviously can come into the mix and make things better or worse. But like I said, guys, you can't control interest rates. All you can control is you as the investor, what you're putting into it. And fundamentally, really what I'm trying to say here, what you're putting into the property is fundamentally what dictates the gearing at the end of it, whether it's positive or negative. In fact, I would even go as far as to say the positive or negative gearing has got nothing to do with the property either, and everything to do with you as the investor. Because like I said, guys, if you're going to go into the deal with no money and you're just going to use equity, that's negative all day long. If you're going to go into the deal and you're going to bring in $500,000 and put that $500,000 onto one property, that's going to be positive geared all day long. You can't really control, you can control what you're putting in. You can't control the market. You can't control what interest rates are doing. So, like I said, guys, gearing is an outcome. It's not a strategy. All right. Now, I also want to deal with some questions that some of our clients have asked here, and I will go through this sort of one by one. Now, is negative gearing a smart strategy? Well, we've kind of explained that. It is what it is, right? It's just, it's not a strategy. It's an outcome of a strategy. Now, what stage? So yeah, roughly that kind of 5 to 7. Now, when it comes to government changes, because this is probably one of those hot button topics that happens around elections, right? So every time an election comes around, it seems like that we play this game of, let's play with negative gearing and remove negative gearing to, appease our fan base and get more votes, right? The reality is, guys, we don't have enough houses in the country. The way that the current legislation works, it's really designed to incentivize or dangle the carrot for would-be property investors, hence why we're getting so much money back in tax. If we take those tax benefits away, for the average punter out there, so for the average mum and dad investor, most of the people listening to this show, I can almost bet buying an investment property becomes a lot less lucrative in your mind, right? And I understand that because it means you're not going to get those tax benefits. So instead of that house, that original house that I was talking about, it was $800,000, getting $800 a week, and that's negatively geared by $30,000 a year. If you didn't have the ability to claim the tax on that because they removed negative gearing, instead of that house end up costing you $9,000 for the year, it would end up costing you $30,000 a year. So what does that mean for investors? It means a lot less investors would want to buy property. When investors do want to buy property, they can buy a lot less because their money doesn't go as far. It's a lot more expensive to own the properties because obviously you're not getting the tax benefits. So your ability to be able to expand your asset base even further and further is going to diminish because you got a lot less money because it doesn't go as far. What do you think that's going to do to the supply of housing? Put it this way. If the government removes negative gearing tomorrow, I'm going to be going to the bank and I'm going to be borrowing as much money as I can get my hands on to buy as many houses as I can possibly buy. Yes, I'm not going to be able to buy as many if there was negative gearing because the banks just won't lend me as much because of tax. However, I would become extremely, extremely bullish when it comes to buying properties because I know the writing on the wall. As soon as they take negative gearing out of the market, it's going to completely disincentivize property investment. A lot less people will be buying properties. Supply and demand. The housing market rockets. Knowing that the capital growth is the number one main metric is building your wealth. And that's fundamentally the only real thing that we want from this property is we want it to grow and outperform the market. I would buy as many as I can because I would know if they took negative gearing away, the market would rocket. Absolutely rocket. Because so many people wouldn't actually be able to feasibly buy and hold on to properties because there's no tax benefits. So I'm very confident that the government's not going to touch negative gearing. And if they do want to remove it, I'm going to buy as many as I can. All right, I'm going to be going ham at buying property. Now, what are the biggest mistakes that investors make when choosing positive and negative gearing, right? And this is really, I guess, kind of where this podcast is coming from today. Most of people's understanding of positive and negative gearing is flawed, right? There's a lot of misinformation out there, and fundamentally, that's really the main problem. I am under the, let's just say that under the naive hope that this episode or this podcast as a whole is really here to help people navigate this market, right? Because obviously the information out there is, somewhat BS for the most part. I'm really trying to use this as a vehicle to help inform people and understand how to navigate things the right way. The biggest mistake that I see when it comes to positive or negative gearing is people choosing gearing as a strategy, or they're choosing a property based on gearing. In other words, what they're essentially doing is they're making a decision based on the cash flow and the tax, not the growth. So, like I said, guys, property investment in Australia, it's all about growth, right? It's the number one thing that's making you wealthy is the capital growth. If you're buying a property to buy and hold, and the growth is the thing that you're not looking at because you're looking at the gearing, just know that you're not using the right lens to actually buy the property. It'd be the exact same as saying, I want to buy an investment property and I want to make as much money as possible, but I'm only going to look at the 5 to 7 suburbs that are around, where I live. You're just using the wrong lens. Like the lens that you're wearing, to go and determine what the best property is not actually going to help you get your outcome. And it's the same thing for gearing. So many people use gearing as a means of investing, or they use gearing as the purpose or the reason. I mean, here's an example, right? The amount of times I've worked with a client, and the client, whether it's a business owner or a high income individual, and he comes to me and says, "Hey, Corey, I want to buy a negatively geared property because my accountant told me I need to buy one to offset my taxes." And here I am thinking, holy shit, there are 10 other ways that I can think of at the top of my mind to help reduce your tax other than taking the risk of owning a property. If you're buying a property purely for tax benefits, you're probably buying property for the wrong reason. Let's just keep it simple, right? If you're buying property because you want to live off the cash flow one day, you're probably buying with the wrong lens and the wrong intention, right? And yeah, I can think of 10 asset classes right now that could provide me way better, stronger cash flow than trying to squeeze cash flow out of a residential home. Residential property is not a cash flow asset. Residential property is a growth asset. It's all about growth. It's all about the capital growth over time. That's why we do it. I see this mistake so often of people buying for the wrong intentions, or not even understanding what their intentions are, like not even understanding why they're buying the property. They're just doing it because their accountant told them to. To say that that's negligence, I think is an understatement from the accountant's part. You need to really get a grasp of this. Now, granted, most accountants are trying to look after you. They're trying to do the right thing. They're trying to help you out and, hit a couple of birds with 2 stones. But, if you're, and I'm sorry, one more thing to say here. When I talk to these clients, and the reason why this is such a problem is because when it comes to the growth, they don't care. They just want tax benefits. And so when they have this indifference about, I don't care about the growth of the cash flow, I just want to negatively gear it so I can get these big fat tax deductions each year and reduce my tax. Like that's kind of insane, guys. Like it really is. It's like you're buying an asset that's really designed to grow really, really well, but you're doing it for the third best benefit. Again, guys, it just doesn't really make sense to me. Now, fair enough. If you want to reduce your taxes, right, I can think of a bunch of ways to do that, right? Now, that doesn't necessarily mean you go and spend, you go buy a new car every year just to write the car off against your taxes, and you can, I'm not suggesting that's a good idea either. In fact, that's a pretty dumb move. But it's almost the exact same thing as buying a property just to negatively gear it just to save yourself taxes. You're basically doing the same thing. You're buying something you probably don't really want, because if you wanted one, you probably have one before your accountant suggested it for tax purposes. you've now got to take the risk of owning that property. You're buying a vehicle you don't want and don't need for this. Again, guys, you get the point. It's insane. The most important thing that I can say to leave you guys with today: understand the intention of what you want out of your portfolio. Like I said, residential property in Australia is a growth asset. Understand that the growth is the number one metric that's going to make you wealthy. That's going to push the ball towards your freedom so much further than any other metric when it comes to property. Secondly, the cash flow has got nothing to do with the property and everything to do with you as the investor. You as the investor, how much money you're putting into it is fundamentally what's going to dictate the performance of the property and the gearing. And then thirdly, when it comes to the tax benefits, it's a bonus, it's a benefit, it's a byproduct. It is not the intention when you come to invest. Cool? Hope you guys got a lot of value out of today. Please keep sending through these questions. These questions are fantastic. The more we get, the better, because then we can have better conversations and better podcasts. And hopefully, with all hope, and again, this might be naive, with the hope of hopefully informing you guys and make better decisions and make more money and put yourselves in better spots for you and your family. That's it for this week, guys. Have a fantastic weekend, and we'll see you next week.